afternoon, everyone. Thank you for joining us for the session hosted by FundsIndia Partner. Today, we are joined by two distinguished speakers: Ashish Khandelia, founder, Certus Investment Management Private Limited; Mr. Manish Gadhvi, CEO, FundsIndia Partner. So, without any further delay, let's begin. To start the session, I invite Mr. Manish Gadhvi to set the context and lead the discussion. Khandelia, who will share insights into the strategy and key highlights of the Certus AIF. Mr. Manish and Ashish, over to you.
So, good afternoon, everybody, and thank you for joining in. By and Certus don't need any introduction, but what is worth sharing with all of you just now is that for the last 2 years we have built a very good relationship with Certus, and many of our distributors experience Certus products, and we are so proud to launch the AIF today. It's not a very complex product. It is just instead of a one NCD, single NCD, it will be a bunch of NCDs. And all of you understand the power of fixed income, real estate, and you've seen it firsthand over the last 15, 24 months. So, really a good product according to me. And I'll ask Ashish Bhai to take this forward, and we'll take questions at the end of the session. Over to you, Ashish Bhai.
Thank you. Thank you so much, Manish. So here and great journey to work with Funds India and all its partners over the last 2 years. It also encouraged us to keep growing the business. And now, as Manish Bhai just said, I mean, fundamentally, we are not changing anything. Honestly, this is the same thing I'm doing for last 15 years. We're just doing more of the same. It is just that we will continue to do NCDs as we had been doing. In fact, we will do it in larger volumes. We will do in larger deal sizes. And what we are doing is by launching this AIF, what it will do is one, it will be a bunch of NCDs. So a lot of partners, certain families, they had been reaching out to us to say, see, we have comfort now. So why don't you just give us an allocation so that we always keep getting that and we automatically get a certain amount of diversification also. With some amount of this committed capital, what will also happen is we will be able to increase the investor yield by a couple percentage points. So now the yields are generally 14.5, 15%. On a net basis, we are targeting no less than 16, 17% of net yield to the investors through this AIF. So that is the thing. So I think product, I understand that most of the audience that we have today, they have already done the product. So they already understand the product. It is the same product, but under an AIF wrapper. So once you make the commitment, we will draw that commitment over a period of maybe 9 to 15 months within that period of time. And ultimately, it will be invested into the same type of NCDs, exactly same thing that we had been doing over the last 24 months with you, right? So that will have continue to have in large current income. Generally speaking, you have seen that most of our NCDs get redeemed in a matter of 18 to 24 months. That will continue to happen. We will reinvest some of that capital so that investors get a little bit more duration. And it basically adds certain additional product. And parallel to that, all these NCDs that you had been doing, that will continue, they will continue to come. So that's broadly what we are doing. What I will do is I will quickly walk everyone through the presentation so that it will refresh what Certus is all about. In that sense, very quickly, I will go through because most of the audience already knows Certus. I will talk about the anchor investor. I will talk about the size, a little bit of the strategy of this fund, which will allow us somewhat more flexibility and avenues to increase the return for our investors and all that. And then we can take questions, right? So with that, so here just very quickly, I will lay down a few things. It's a very experienced team. It has worked at large global institutions like KKR, Morgan Stanley. There's more than 20,000 odd crores of transaction experience. And in any of our investments over the last 15, 16 years, we have never lost any capital. And in very, very limited scenarios, we lost a little bit of return during the COVID times, right? So this is the experience of the team. Certus itself is now 8 years old. As Certus, we have done a total of about 10,000 crore of deals, including about 2,000 odd crores of the kind of deals that you all have been participating in. Investors are making a net return of about 15 odd percent. At a gross level, those deals are already at about 18 odd percent. So very, very similar to the strategy that we are kind of talking about. Many of you have experienced the convenience of the tech-enabled platform that is there, which allows a lot of updates and transaction process to happen in a very transparent and easy manner. So we will continue to provide that convenience. TFCI, which is Tourism Finance Corporation of India, has already come in as an anchor investor. They have also invested in our fund. They have experienced us, and they would really wanted to extend that relationship. So they're committing to 10% of the fund, right? So that's there. I think market opportunities remain strong. We will talk about it. There's a very strong investment sandbox that we work today, which will continue to happen, where there is a certain selection criteria that we apply, which we will talk about. We are clearly targeting at least 20 odd percent plus gross returns on this AIF, which we are very confident of doing. The deal pipeline itself is very strong, and we are not trying to raise too much capital. In most, the problem happens when you try to raise too much capital and then you don't have good opportunities. So that's kind of when there is a problem that happens. So we are raising capital, which with this capital plus the bonds business that we are wanting to continue to do is appropriate for the size of the market, for the size of the volume we want to do over the next 1 year. Our expectation is that this AIF that we are raising, we will call all of this capital in a matter of 1 year to maybe 15 months time. Next slide, please. Yeah. So I mean, it's just touching upon the same thing. Today we have more than 2,000 investors. Thanks to the participation by a lot of you that has helped us get to this thing. We have fully exited 7 deals, which is basically a testament to the fact that between 18 to 24 months, we end up exiting most of our deals. And we have already returned 18% plus gross at a gross level. Of the investors have already made 15% plus minus of that. Several financial institutions have participated. And despite the returns that we offer, the unique thing is that no other credit AIF offers this. Our entire return is serviced either monthly or quarterly. So there is no peg, there is no back ending, nothing of that sort. It also keeps the investment discipline. The other thing that I would really like to highlight is under our current platform, almost we see a 75% repeat. So if an investor has come in by value, 75% of our investors have been repeating. As I mentioned, Certus in itself, just in its 8 years of journey, it has crossed more than 10,000 crores of transactions. I mean, just the team. I mean, of course, I've spoken to some of you a couple times. My own background is I have been doing this business for about 25 plus years. Was at KKR, Kotak, Morgan Stanley, etc. Sahil, who heads our investments, he was at Morgan Stanley for 14 years, including 7 years where we worked together. He has been at Certain for more than 7 years now, just about 7 years now, right? Siddharth kind of handles our origination, again, deep experience. Gaurav, who is our CTO, he has also been working closely with the Funds India tech team to enable certain things which are even making it more easier. He's an IIT Mumbai graduate. He himself is a PropTech SaaS entrepreneur. Next slide, please. I mean, these are some of the things I think from the very beginning, from 2019 onwards, when we were just about starting off to today, it has been a very deep knowledge-led approach. So we constantly are able to present ourselves at the most distinguished forums of real estate and credit investing in the country. Next slide, please. Yeah, it's just a bit of a reflection. I talked about that we have about 20,000 crores of experience, and you would see that it is a fairly broad-based experience across asset classes, across sectors within real estate. So it's just not so that gives us a 360-degree understanding of the sectors. We can make an understanding of what is happening in the office sector and what will be its implication on the residential sector, vice versa. How the trends are moving, and so on and so forth. And that has helped us make sure that we are able to create a balanced portfolio across asset classes and cities. And as I mentioned, one of the scare that a lot of people have had in the past, that a lot of people have lost their money, their money has been stuck. We have seen 3 different cycles between 2005 to today, right? And for us, the most important thing, especially when we do credit investing, is to preserve our capital. And that too many guardrails, too many very intensive asset management processes that we apply, which ensure that our capital, the risk to our capital is really minimized. Next slide, please. So I think the other thing that I want to highlight, and we may not have spoken much about it, is that while we constantly engage with this whole community on various 150, 200 crore kind of transactions, but I just want to say that Certus as the firm, and in terms of its history and in terms of the expertise, we have very sophisticated expertise to deal with some of the most complex transactions. So when we started, before we launched our own bonds business in 2022, for the first 4 years of its life, we advised some of the largest global institutions on deals that were minimum 1,000 crore or upwards. And those kind of deals exist in the market, and some of those deals offer even higher returns, right? So these are just examples of few of those deals. I mean, between just a matter of 4 to 5 deals, we did more than 8 to 9,000 crores, right? And this is the same kind of expertise that we actually bring to the bonds business that we do and to this AIF that we are doing. And you would see that each of these organizations are a minimum $100 billion plus of AUM globally. And we were advising them when they would or basically create their space in India, right? So the reason I bring this is so that when you talk to your investors and all that, there is comfort that there's a very deep expertise that we bring to the table when we are doing any kind of investing. Next slide, please. Is what I was talking about. I mean, in terms of pure credit experience, when we look at it, and this was among the toughest vintage. Basically the markets were slowing down, too much capital was being pumped, too many people lost a lot of money during this period. And even when I look at this period, I mean, basically during that period of time, I was at KKR and we invested about close to 4,500 crores, right? Effectively, out of that 4,500 crores, 4,000 crores returned 14% or upward, which is what it was contracted.
So I think
Yeah.
so. So I already mostly spoke about this slide. This was just to give an indication in one of the toughest vintages when the markets were going down and too many NBFCs and HFCs and housing finance companies lost money. We never lost any money even at that point in time. And these couple transactions where we lost a little bit of return was basically onset of your ILFS crisis and COVID, and then also we were able to get full return and high single digit returns in that scenario. Next one, please. I mean, here, this is exactly where I think we had been working with you all. I mean, we had been working with this community for about 2 years. We started the business almost about 4 years back. And of course, for the first 2-3 years, we were just really establishing the fundamentals, educating the market how it is doing that. But I think 2-3 things that I would really like to highlight here is while there are a limited number of deals that ultimately you all end up seeing, we scan through thousands of crores to really select a very limited few deals that we finally do, and the acceptance rate for the deals that we receive to what we finally do is less than 3%, right? So we have scanned more than 30,000 crore of deals to do about 600 crore of deals in MMR, and so on and so forth. Each of our interest payment has been on time or ahead of time. Each of our capital repayments has been ahead of time, right? And you would see that we have focused on a very disciplined growth, right? And basically now with the whole ecosystem set, etc., everything, this growth is accelerating. So this year we have already committed more than 1,000 odd crores, more than 600-700 crores of this has been disbursed, and the rest is getting disbursed. And all the deals that we kind of have showcased have performed in line. The other very important thing I would like to highlight that we all really, and that's what matter to our investors and to us, is that the interest and the principals are coming on time. But it is also useful to see what is going below that. We focus a lot on underlying project performance. We work intensively with the developers. We control all their escrows. We control all the NOCs for every sale that they do. So it ensures that it is not left to the chance. I mean, it is not only about investing, but it is actually hand-holding the developers and the project throughout the life of that project cycle. And that is what really ensures successful projects. That also incentivizes them to keep coming back to us, because many other lenders, they have not been able to follow the same kind of a journey. So by ensuring their success, by ensuring the success of the underlying project, we are automatically ensuring the success of our investors and a very high quality of repeat deal flow. That's kind of the secret. Next slide, please. I mean, it's just like, while a lot of people know Ritesh here, but there is a very large team that actually supports the whole business, from investing to asset management to compliance, administration, technology, finance, operations, and all of that. So we have more than 25-member team overall. Next slide, please. I mean, these are just some of the partners that we have worked with. You will see some of the largest companies like Oprah Reality and Punchil to Casagrande to Cybercity, and also smaller companies. And this combination allows us to really create very attractive returns, and use a diverse mix of counterparties. Next slide, please. I mean, and also, I must highlight, this is a very key ecosystem We work with the best of lawyers, monitoring agencies, due diligence agencies, technology companies, escrow banks, trustee services, financial institutions. So there is a large ecosystem that really work behind making these deals success. So this is just a representation of the ecosystem that we have. Next slide, please. Many of you are familiar with the tech interfaces that we have. We can just move on. Next slide, please. So I think this was a little bit more about the background of what we have done, what Certus is all about, what is the expertise that we have, the ecosystem that we have. Now I'll talk a little bit more specifically about the fund. And honestly, as Manish highlighted earlier, all of you are not new to this product at all. It is just that same NCDs are coming in the form of this AIF. So nothing new about the product. It is just the way of participating into the same product. We can go to the next slide. So here it is. I mean, few things I would highlight. The fundamentals, real estate, while we all worry a lot about real estate cycles, prices going up, prices going down, honestly, to us, it does not matter. Real estate is a consumption asset class in India. There is a certain demographic, there is a certain amount of houses that needs to get sold every year. And that is just, we don't think of, when we are investing into this, we don't think of consumers as investors alone. We think of them as end buyers, and therefore we focus on projects which have fundamental demand, right? And that is just demographically, like there is an X number of cars that get sold every year. Similarly, there is an X number of houses that will get sold every year. It's a little bit like that. But the interesting part about that is because of various, real estate is one of the sectors where there are two key raw materials. One is land, second is capital, right? Because it requires very chunky investment from day one, and a large amount of capital needs to go in before it can start monetizing that capital. And for the same developer, he has to keep doing it again and again. To just contrast it with, let's say, a manufacturing unit, I mean, a company which has put in a large plant and all of that stuff, it will have a significant capital investment at the beginning, but then later on it will just keep growing its working capital as it grows. On the other hand, in real estate, every time you acquire a new project, it is a large capital outlay. So to that extent, the capital requirement of the system is very, very large. And also by virtue of several restrictions, rightly so, that Reserve Bank of India has put on banks and non-bank finance companies and housing finance companies, a large part of this capital cannot be serviced by this ecosystem or financial services ecosystem. So that creates this huge gap, right? I mean, JLL estimated that requirement is of almost 4 lakh crore, right? And against that, the availability of capital, especially after the ILFS crisis of 2018 and 19, is really, really reduced. And that gives us this opportunity. I mean, by and large, most of the projects that we've brought to you all is post-RERA or very near to RERA. And then also we are able to produce this kind of a return. So it is the expertise on the structuring, right selection, and we are benefiting from the fact that there is capital paucity. So we feel that this market opportunity is very, very large. The fund that we are raising in that context of 500 crore is a very small fund. So we do not worry about deploying it at all. You have seen in FY26 itself, we committed more than 1,000 odd crores. So we are very confident of deploying this capital. We already spoke about Certus Capital and its deep expertise as a team and as an organization itself. Anchor investor here, which is Tourism Finance Company, it's a 35-year listed company. LIC is listed as the promoter of this company. It has an AUM of about 16,000 odd crores. So it also brings in an additional level of partnership, an additional player who will be sitting on our advisory board, and will further add to the expertise that we have. So we are very excited to have them here, and therefore our fund is called Certus TFCI Real Estate Fund. The product is the same that you have been experiencing. This is high yield fixed tenor secured debt deals, with people who have proven execution and a financial track record. We are very, very focused on not investing into products that will not sell. So we really focus a lot on market fit. A lot of people worry about construction. Honestly, if you have capital, if you have approvals, your land title has no issues, construction will happen. But you will get stuck up if you have chosen a wrong product. I mean, in a peripheral location, you ended up investing into a very high-end project. It will not sell, And at the same time, if you, at a very high per square foot ticket price, you have created very small houses, they will not sell. So there has to be a very good maturity in terms of what is the right product. Also, there has to be a good mapping between the product and the developer that you're partnering to deliver that product. A luxury real estate player may not be able to do affordable project, and vice versa. So so there is a lot of mapping that we do in that thing. There is a very rigorous monitoring that happens. Every single invoice of the project comes to our monitors. It is approved by our monitors. Then it comes to our team. Our team approves it. Then it goes to the trustee. Trustees issue the instruction to the bank, and that is when that invoice is paid. That is the level of control that gets exercised. And we use a very high intervention of tech to ensure this workflow and all that is well managed, right? The other thing is that we have a very strong alignment with our investor. We have always had, in our bonds business, we pretty much put our entire balance sheet to buy these bonds, and then they are sold down, right? So it should give you a sense of what is the level of comfort that we have on these. When we invest on day one, we go with the viewpoint that if tomorrow even not one bond is sold down, we should be able to sleep at night with that chunky amount of investment sitting on our own books. And that's the level of diligence that we kind of do. So there is a very strong alignment of interest. Just about the terms, we are targeting, we have written 20%. We really want to target somewhere between 20 to 22%. The overall fund tenor as per our PPM is 7 years. Our expectation is that we really want to, invest this fund quickly enough and turn it around, maybe one and a half to 2 time turns of this fund. And basically in about 5 years time, return all of this capital. So if you look at it, let's say it takes us about a year to invest the entire capital, then it takes about 18 months from there on for that capital to by and large come back. So between 2.5 to 3 years, this capital will come back. Some of that capital we will redeploy, and so that it kind of comes back by the end of 5 years. And by the end of 5 years, we are able to return all the money to the investors, right? So that's how we are thinking about it. But just to keep in mind any kind of market contingencies and all that, we have termed it out from a SEBI point of view for 7 years, because if you are stuck in a wrong cycle or a wrong year or a COVID kind of a thing happens and you need an extra year and you don't have it, then there is a very draconian provision through which SEBI forces you to liquidate it, which we don't want, which leads to investor losses, which we don't want at all. Next slide, please. So here is the strategy of the fund. Again, very similar to exactly what we had been doing. We intend to not take more than 15% exposure in any single deal on a hold to maturity basis. We will be buying and large investing all our capital in tier 1 cities. Most of our capital will go into the residential segment where it has been going even as of now, or for sale commercial segment to a certain extent, as you see even today. And very opportunistically, we can look at some other sectors. There is a certain portion of the portfolio which we don't really do in the form of bonds, but the kind of transaction that I was showing we did with global financial institutions, we can add 25 to 30% of those kind of transactions, which are equally secure, equally protected, have a certain special situations elements to it, but that can allow us to have 2-3% more return on a portion of the portfolio, right? We are and that's how we are really looking at a portfolio construction which is giving us at least 20% plus return. Again, on the partnership, same process that we have always followed. We want them to have had a decent amount of delivery experience and a good financial health. They should have a proven track record. They should not be a defaulter or a company in stress, right? We avoid projects which have any kind of material discretionary approval risk. Basically a builder saying that, okay, the rules only allow for 25 floors, but I'm going to go and get another 10 floors from the government. We don't invest in that kind of a thing, or we don't really underwrite that thing, right? We will stick to most of our top cities where we have a deep expertise. We have a very strong emphasis on financial closure of the project. This is the main reason why a lot of real estate projects are stuck. So we focus on this very strongly, and that's why basically there is enough capital we always provide to a project to get it to completion, right? So that's the thing. We already talked about regular servicing. While we have written that about 70% of the portfolio will have regular servicing, our intention is to kind of ensure that almost 90-95% of the portfolio has proper regular servicing. Next slide, please. We kind of talked about most of this stuff already, so I will not repeat again. But and many of you are already privy to kind of the project matrices, the covers, which is typically between 2 to 2.5 times, very active asset management, very institutionalized diligence processes. So many of you are already privy to that. So I will not repeat what we have already just discussed. Next slide, please. I mean, this is just some of the examples of the transactions that are going on. Not all of them may go into the AIF. It all depends on when the closure of the AIF is happening and when we are closing these transactions. But we talked about this 315 crores of deals are actively under pipeline. Yesterday, we closed this 110 crore of deals. It's already now live. We are in advanced documentation and almost completing diligence on this 90 crore of deals, and this one the diligence has already started. So what we are listing here is a very real pipeline, and you would see that at the moment also we have another 800 odd crores of deals that are already going under various kind of this thing. In fact, I have a meeting with the promoters today in BKC for this 225 crore of transaction that we have listed here. So very, very active pipeline, which gives us a very high degree of confidence in, for most organizations, what happens is when they're raising an AIF, that is the start of their business, especially if they're raising their first AIF. In our case, that's not the case. I mean, we have already finished close to 20 deals, 18 deals in India, and already exited 7. So just a completely running well-oiled machine. We are just adding AIF as a product to that machine rather than it being a start of our business. So we don't think of this AIF as like our first time AIF or anything of that sort. We already have a small AIF which was done only for friends and family. So if the whole regulatory setup, we have had SEBI registrations for more than 5 years now on that matter, and it is just one more format that we are adding to it. Next slide, please. I mean, this is the advisory committee. I talked about TFCI. You can see the background of some of these people. They are very, very experienced with 30 plus of years. So we are excited to have them as a part of our advisory committee. At the same time, all the day-to-day operations, handling, investment decision making, etc., will continue to be handled by Certus as it has always been in the context of bonds, right? But we did want certain kind of external people whom we can knock on and just make sure that when we are dealing with people's fiduciary money, there is more expertise and sound bites we can get on that. Next slide, please. I mean, this is just the structure. Certus India Opportunities Trust 2, as I mentioned, it is a second AIF, is the trust. Certus TFCI Real Estate Fund is the scheme of that trust. TFCI as an anchor investor has already committed about 10% of the capital. Certus also will be committing between 15 to 20 crores of that. Some of our long-standing direct investors have already committed another 25 to 30 odd crores. So between these three constituencies already without even launching, and this is the first call we are having on the launch of this AIF, but even before going there, out of 500 crores, 100 crores is in place. So that should give you a lot of confidence when you talked about to your investors that people who had been close to Certus or who has been engaging with Certus are already very bullish about this AIF and are participating in that. Right. We have the best of legal and tax advisors. We have Khetan and Company. We have BDO and Pricewaterhouse as our legal and tax advisors. We have Ernst and Young as our auditors to this fund. So we are using the best-in-class companies and service providers to monitor and to audit this AIF. Next slide, please. I mean, these are some of the key terms of the fund. This presentation will be available, so please feel free to. The way we are looking at it is when we close, we will basically probably look at 25% of capital being called upon, and then the balance capital, as I was mentioning, between 12 to 15 months will get called upon. Some of these terms and all that we have discussed with the Funds India team, so they will be able to take you through in more detail about the terms of the fund. Next slide, please. Yeah. So, I mean, I won't spend too much time on it because this is the same product that we are running. But if somebody wants to understand more about the market, we can cover that in the Q&A session. But I would say just purely from a cycle perspective, we are in a multi-year cycle. We have seen very robust price growth. In my view, the price growth will stabilize now over the next 3-4 years, but the volumes will sustain. And the good part is because of low capital availability, because of RERA, because of IBC, various things that basically disciplined the sector between 2016 and 2020. I think we are seeing a very good balancing between people being focused on the supply that they bring to the table and that being reasonably matched with the growth or with the volumes that are required or being absorbed in the market. So to that extent, if you will look at it, one of the things that we track quite closely is the years to sell inventory, which is basically the unsold inventory divided by the absorption over the last 12 months. And what is that number, right? And that number has dropped to as low as 1.2 years, which is a very low number actually. Typically speaking, any number which is about close to 2 odd years is reasonably healthy, because it typically takes 3 to 4 years to deliver a real estate project, right? So that way, I mean, we are quite in a very comfortable market, even if the price growth slow down, which it should ideally speaking, because if it keeps going up, it starts making affordability a big challenge. So I think it has caught up the inflation loss that it suffered between 2014 to 2020, and therefore we saw a very robust cycle. And I think it will be more moderate, which will ensure that the sales of the project is happening in a bit more moderate way. There is more need for working capital requirement. More stronger players are being able to play the market, and it basically creates better opportunities for people like us. So that's kind of where we feel the cycle is. Next slide, please. Yeah, we kind of talked about some of these things, but this is what I meant about it being a fundamental consumption sector, as opposed to it being driven by investments. Like the difference between a stock market and real estate. And a lot of people think of real estate and people buying homes as investment, but honestly, it is an investment. It consumes for many people their whole life saving, but it is really for consumption. They actually get physical benefit out of it, and that's how we think about it, right? There is an increasing preference for home ownership, especially after COVID and all that. This actually was intensified because a lot of people felt that they would rather have their own homes as opposed to just staying in rented homes. Urbanization is rising, our income levels are rising, aspirations are rising. That is also wanting people to do that, right? Our office sector has been doing very well, and there's a very structural correlation. Every 1 square feet of office leads to 5 to 6 square feet of residential demand. So and with this government, I think there has been an extreme focus on infrastructure. So a lot of areas which were otherwise be far flung now are becoming part of a very developable zone, and that is also allowing more real estate developments to happen. And then with the RERA and the GST coming through, I mean, it is just cleaning up the sector a lot, especially in tier one cities. Now there is a much more reduced incidence of cash sales, especially among organized developers. Next slide, please. So this is what I was kind of mentioning. Basically, you would see that, after ILFS crisis, up to the build-up of the ILFS crisis, NBFCs and HFCs were indiscriminately lending to real estate without having the right expertise. And they went from an AUM of just about 56,000 crores to almost 2.5 lakh crore, about almost 5x in a matter of 4 years. And this was driven by the fact that they were just looking at attractive yields of real estate without really having the knowledge to run that. And that caused the crisis. That made Reserve Bank of India put very significant restrictions and take several, and HFCs, which were actually otherwise governed by National Housing Board, also came under the purview of Reserve Bank of India. And now you would see, while the sector has been doing actually quite well, their AUMs dropped significantly and they have remained at those levels. And it is effectively, when they were doing land financing, various different things, now they are restricted to a limited, which basically creates a significantly larger space for people like us to provide capital solutions. And most of these people, most of these financial institutions, they are very large. They are really not equipped to do the level of monitoring that we do, and therefore it is also not their expertise to do the kind of structures that give us the high returns. And that also allows us to tap into those kind of returns. Next slide, please. We already talked about this thing, so I will not repeat it, but there is a very large demand and there is a very low availability of capital, and that is really allowing us to create these attractive returns. Next slide. Yeah, this is the same point that we just talked about. There is no new thing here, but all we really wanted to highlight is that fixed income is a very large allocation. Today, your traditional income instruments on a net of tax basis do not even beat inflation. And therefore, there's a very significant need to really work with smart private credit capital if you really want to create regular paying passive income, but that is still attractive enough in terms of returns. And that's exactly where our bonds product, and this AIF comes in. And there is like almost twice the delta of the return that your traditional fixed income products provide versus what this AIF can provide. I mean, this is just talking about institutionalization of the real estate sector and enormous amount of global capital. Largest of institutional global investors had been investing into the Indian real estate. But that benefit has not really been properly made available to the Indian investors, which is now only starting to happen. So we just see that there is a massive roadmap, and if you all work with your clients and educate them about it, there's just a massive roadmap for a lot of domestic capital to come into the sector. Next slide, please. I think we can very quickly go through the next shares without running through it, but just quickly the next slide. So I won't go into the details of it. I mean, people can read it, but there is a very detailed diligence, negotiation, committee approvals, final approvals, the execution process that happens before an investment finally is brought to the table. Next slide. Yeah. So this just kind of lays down the kind of experts that we use for pre-deal diligence and post-deal monitoring. Very, very extensive process again. Next slide. Yeah. These are the various risks and how we handle them. I mean, again, I'm not going into the detail of it, but happy to answer any questions around that because many of you have already experienced the product. I mean, with that, I will pause. I mean, happy to take any questions or any concerns that people may want to discuss.
Thanks, Ashish. First of all, I think so. What we should probably repeat one more time is what is the returns that people should expect, like a range of returns, good scenario,
Right,
normal, bad, right? Uh,
right.
then drawdown schedule, right?
Sure.
And the last thing is in terms of cash flows to customers, right?
Right,
What is the likely 1 year, 2 year, 3 year, 4 year cash flows are going to be? I mean, what is the life of the fund? Can if you have something on those lines, it'll be interesting. But let's start with returns first,
sure.
and explain it to them how one of the things which the question will come up is that if I'm investing, let's say 20 lakh in NCD, and I'm making about 15% returns, will I make more here or should I just keep buying NCDs? So that is question one on returns. And we can share a range, means good
Right.
scenario, bad scenario, average scenario, and draw down, and then probably, what will the 1, 2, 3, 4 year returns to customers look, cash flows will look like. Yeah.
Right, right. So addressing the first question on returns, and also comparison between the AIF and the NCDs, and in our mind, they are both fantastic products, serve slightly different purposes. So the returns on the AIF that we are really looking at is a return range of between 20 to 22%. On our NCDs, as I mentioned, we had been already delivering 18, 19% returns at a gross level with 15, 16% going to the investors already, right? So so the reason we can do a little bit better, one, we have a large amount of committed capital that is already there, which allows us to even move faster and kind of close out deals. The second thing which will allow us to increase the return at the AIF level will also be doing some of those opportunistic transactions that we have only done with the institutions, the kind of institutions I talked about. Those kind of deals come to us all the time. We generally don't do it under the NCD format because it is a much simpler format in that sense. Those bonds may have some 10, 12% current return and maybe another 8, 10% as accruing return and all that stuff. So a small portion of the portfolio we may do in that, right? So that allows us a little bit more flexibility around that. The third thing that can happen is, and we have already seen this thing, there's a constant demand for a lot of NCDs, right? What the AIF will also be able to do is that basically lock in the returns at good 18 to 20%, hold them for 5, 6 months, and maybe a portion of that and it can sell to NCDs, which then becomes a win-win because the AIF benefits from trading and some capital gains on that thing, and some of the investors who want to do smaller tickets can do only 20, 25 lakhs and not a crore or plus that the AIF requires, will still get an NCD which will be at 15, 16%, and maybe the project has also progressed a little bit, right? So overall, we are really targeting a gross return of about 20 to 22%, and basically on a net basis, after paying the fees and the carry and a small amount of expenses that may happen at the fund level, and we are trying to keep them reasonable. Honestly, the idea is that we create great experience for our investors and for our partners. So on a net basis, somewhere we are looking at return range of between 16.5 to 17.5% on a net basis going to the investors after all of
Post
this.
fees, pre-tax.
Post fees, exactly, post all F related expenses and leakages, including expenses, but pre-tax, right?
So let me just repeat what you just said. That let's say on a normal NCD, right? You originate that at 18%. Let's say subsequently sell it at 15, right? Now, if the AIF were to do that, right,
Right.
it earns 18% while it is on its books, right?
Books.
Sells it at 15, so probably make 3% as capital gains. So that's
Right.
probably broadly you how you get 18 plus 3, which is about 21, right?
Correct.
That's
Correct.
precisely one of the ways.
That is exactly one of the ways.
Correct. So about 20 to 22% of gross returns, about 16 and a half to 17 and a half of net returns, right? And what's
That's
the
right.
drawdown right now?
So the way we are looking at, Manish, is the fact that we are not trying to raise a very large fund, and there is a strong origination machinery that is already there. Idea is to draw this down. So when we do the initial close, maybe when we sign the contribution agreement, we will ask the investor to put in a 10%, so that it secures it for the partner, for yourself, for ourselves, everyone, that the investor money is there. And basically, as we do the first close, which will happen very, very quickly because the 100 is already there. So I think the way people should guide is that on closure, on their signing, they should expect to provide 25% of the capital, right? And the balance 75% come being drawn over the course of next, I would call it, between at a broader range between 9 to 15 months. Idea is to draw the whole capital from 0 to 12 months time frame.
So another 25% every 3 months. Is that fair?
Yeah, that's a fair way to think about it.
And 25% at the end of March, or what are you thinking of?
Could be, I mean, if we all move very fast, we can do it end of March. It is already approved by SEBI. Everything is there. We are just finalizing the contribution agreement, which will get finalized in the course of this week itself. Or maybe it might spill over to sometime in April.
April. So March, April,
Yeah,
25 lakhs
March, April.
should be,
Correct.
and
Right.
then it's like July and
Yes,
normal.
that's right. Yeah, yeah.
Cool. And let's say I invest the 1 crore rupees, and the first 9 months my money is going in. What will
Right.
happen from year two, year three, year four? Do you have
Right.
a broad?
Yes. Yeah. We will ultimately create a numerical example and also share it over the course of coming week. But if I were to give a guidance, the way to think about it is that we will invest this capital over the course of next 12 odd months. Then this capital will remain invested over the course of, I would say, next 3 odd years, because it may come back from the deals, but we will do some bit of reinvesting of this capital, right? So let's say you can expect that there is the capital is getting contributed between April 26 to March 27, broadly speaking. Then between March 27, March 28, March 29, it is probably fully invested. From April 29 to, let's say, 2 years later, from there is when it kind of starts to slowly come back, some bit of it. So the acceleration of 1 year to invest, 2.5 to 3 years for it to remain invested. Let's say about 2.5 years it remain fully invested, and after that it starts getting harvested and coming back, right? So
So
that's that. Yeah. So I think mid of 29 onwards is when, in my view, it starts coming
coming
back,
back.
and then over the course of next 1.5 years, it gets. So that's what I'm saying, that let's say we start doing it now, we draw the capital up to 27, and then we want to really return all of it between fourth to fifth year of that.
So the first 12 months is when you invest money.
Right.
Though it will start fetching some returns, right?
Right.
You will then stay invested for say another 24 to 30 months.
Another 24, or I would say maybe another
30.
30 to 36 months. Yeah, we stay
So
invested.
24 to 36 months you'll stay invested.
But yeah, after 24 months, some of it will start slowly coming back.
Okay. Okay. So you'll, let's say, first 12, 0 to 12 is investment, right?
Correct.
12 to 24 is staying invested. 24 onwards is some cash flows will keep coming to
I
the
would say
customer?
24 to 36 is when you remain fully invested, and between
Okay.
36 to 60 is when it starts coming back. So from 0 to 60 is when we really want to finish the full cycle.
Right. So it's an end-to-end 5-year product,
End to
but
end 5-year product with the
but
average life of probably 2.5 to 3 years.
correct. So the real investment phase is, I would say, 24 to 36, right? The two
That's right.
years where you are fully invested, and
Fully
then
invested.
as the money will go in slowly, it will
Right.
come out, start coming out,
Come
and
out slowly.
and are we planning to pay anything in?
Yes. So basically, whatever is invested, our endeavor will be that at least 10 to 12% is actually regularly getting paid,
So
on them
of the gross
of the
20
invested capital,
of the of,
of the
correct. So
gross, of the
of the
gross.
gross 20-21% return,
Right.
we plan to pay 10 to 12% regularly, right?
Regularly, at least. Hopefully more, but at least that much.
So I think so. What will be helpful is that if we can chart out this 60
We will
months,
chart this out. Yeah.
right, and share it to though it's tentative, people know this, but that's
Sure.
broadly what we'll try to do. Cool.
Right.
I think so. There are one or two more questions, and what else? So yeah, we have 4 deals already logged in. You warehoused it somewhere, or it's still
No, honestly, because all of those goes away. I can warehouse them, Manish, but then you will only tell me not to do that. So I'm not worried about that. We are not worried about warehousing these deals just yet. But yes, what will happen is, let's say I give you the example of 225 crores. So now that this AIF is very, very real, some of the deals that we are doing now, and they will also have deployment in stages. So we will start now locking in a certain portion of the new deals in this for this AIF.
so we are looking at what, 9 to 10 deals, or we're looking at
Yeah, about 9 to 10
about
deals.
8 to 10 deals, right? Because the
Yeah,
fund is, let's say, 500 crores, so average
yeah,
50 crore exposure, or maybe
correct,
even
correct,
higher, right? And if
correct,
you raise
correct.
more, then the number of deals can go up. But
Can go up
currently,
a
the
little bit.
target is about 6 to 10 deals.
But yeah, maybe six. Generally, we would like to do at least 8 to 10, so people get a diversification of good 8, 9.
Couple of questions on this geopolitical risk, or on the liquidity cycle in real estate market. So
Right.
what are your thoughts on that?
So honestly, what's happening is, and maybe some of the people here will be better experts than me on this, but what we are seeing is that private credit as an asset class is becoming bigger and bigger for two, three reasons. And real estate private credit, what we are doing is a subset of that. One very simple reason is between 2008 to 2022, money was practically free. All the central banks were running at very, very low yields. Global Western central bank were zero yield, right? Today, that has increased a lot. I mean, the US Treasury traded between 4 to 4.5%, right? So the money is not cheap anymore. The second thing is, because of these geopolitical scenarios, right, and I will come to one very specific example within real estate asset classes itself. The ability to take longer term bets have in fact reduced, because I'm happier taking a look at a project where we know, okay, in the next 2 3 years my money will get done, dusted, project will get sold, and the money will be back. Now, any kind of a geopolitical or a technology disruption that happens, that generally affect the terminal values a lot more than it affects the immediate cash flows, right? And this kind of a strategy ensures that we are dealing a lot more with immediate or near term cash flows as opposed to terminal values. Now let's just give you an example. Certainly with this cloud coming up, a lot of our IT sector took a beating, because generally speaking there was this feeling that the long term value of these companies now is going to get diminished because something else is going to impact that, right? But that impact has an immediate reflection in the share price, but in terms of cash flows it will take a period of time to catch up. And therefore, even if globally, if you look at it, the firms like Blackstone, KKR, and all that, their largest AUMs are now private credit AUMs as opposed to private equity AUMs. So I think this whole asset class, which is a relatively new asset class, it's more like 20, 25 years old as opposed to private equity, which is almost 40 years old. I think it is finding its space and value in that. That is feeling number one. The feeling number two is, while globally things are quite in turmoil, thankfully, India, given its very large domestic consumption and very large domestic base of everything, I think is somewhat more insulated. from that perspective. We are not entirely insulated, but somewhat more insulated, right? So we, in that context, like this self-liquidating kind of a strategy where we are really not relying on exits by one single stroke of big things. In a typical private credit business also, like a lot of other private credit funds, what many a time they are also focusing on is giving capital, and the company will sell itself or do some acquisition, and that will create this thing. On the other hand, I'm relying on hundreds of investors or hundred of consumers buying a house, right? And it may slow down by a year or two. You will look at it, all our bond presentations. We do a lot of scenario analysis. So my feeling is that for the next 2, 3, 4 years, I think the strategy, we don't see any disruption to the strategy when we will be operating this thing. We do expect the working capital cycles to be longer. Right. So if a product will get sold out in about 18 months' time, we are underwriting it will take probably 30 months to sell. And therefore, we are providing for more working capital, which is also giving us a slightly better opportunity to invest a little bit more capital without creating any additional risk. So that's kind of what I think, Manish.
I mean, if let's say, I mean, we have not seen any of your projects being delayed or anything which is, bad, right? But let's say, for the sake of this risk assessment, if we are aiming at 2022, right? If one or two of those NCDs, project delays, slow down, what's the minimum
What's the
that,
impact?
yeah,
What's the
what's
impact?
probably what is the other end of that 2022?
Right, right. So see what happens, and this is where how we also look at what is the impact of a project not performing as anticipated. So there are several layering of that impact that it goes through. First and foremost, when we construct our transaction, we any which ways create a significant amount of buffer for about a year and a half, 2 years of movement in the project life cycle, right? That is embedded in the project underwriting itself. And this is, you take all our last 10 deals and you will see that kind of a scenario analysis in every single deal. The second thing that happens is, okay, something has further worsened, right? So first and foremost impact should be just on the timing. Okay, I should have gotten my money in 3 years' time. It took me 4 years to get the money, but I should have no loss of return, no loss of principal, but just took a bit more time. Then the next level is, okay, something really went bad, and I gave you two examples that happened in my own portfolio where there was a COVID, where there was ILFS immediately followed by COVID, LTVs became high, and instead of hanging around in those deals, we decided, okay, I will take a hit to maybe 5-10% of the return and take my money back and go home, right? And if that were to happen, let's say even if we lost 10% return in, let's say, one deal, right? Across 10 deals, that's like 1% loss at a portfolio level, right? So as long as we are not making any fundamental mistake in terms of the title or the approval risk, the impact on return of something moving around could be maybe 1 to 2%, right? So let's say we were looking at a 20% gross return, and I'm assuming this means the market was bad, so instead of making 22, we are already at 20, we lost another 2%, maybe we are at 18. That's kind of the thing. Honestly speaking, and while a lot of people have lost money, I don't see why, when you have a hard asset and if you're doing your job sensibly, why should you lose money? You lose money when you have taken something fundamentally wrong about the title, and there the diligence and the diligence frameworks have evolved a lot. So you can never say never, but we are highly focused on not losing capital. And as long as we don't lose capital, the impact on return in a bad scenario can't be more than maybe 1 to 2%.
Correct. So I'll answer one question, and then I'll put one more to you, and we'll end this session. It's already 1 hour 3 minutes. Somebody's asking, if I am making 15% on an NCD, why should I commit 1 crore and invest in an AIF for just 1.5 or 2.5%? The answer to that is that NCD is concentrated. It's a single security, and this is a portfolio of securities, and you're not paying 1 crore at one time. So it's like buying 10 NCDs by paying 1 crore, which is, if things which are what we are doing currently with NCDs is that we have decided a ticket size of 20 lakhs. So you're buying something which is worth means ideally on an NCD route, you'll have to put in 2 crores to buy 10 NCDs. Here you will get 10 NCDs in 1 crore. and it is a diversified portfolio, and 1.5, 2.5% returns is compounding in long term really it changes things. So that is the answer to that. How is this fund different from Motilal or Aranya? I think so. It's the same thing, right, Ashish? It's real estate backed debt fund, right?
Yeah.
So similar, I would say, Mehul. And yeah, I think so. That is the. We'll end here, Ashish. I think so. We've taken enough of your time. Thank you for joining us. We'll work hard. We think it's a great product. We are Certus of us here in Funds
Thank you
India,
so much.
right? And
Yeah,
though we work with Motilal and Aranya as well,
of course.
so
Sure.
yeah, so we will work hard and try to raise as much money as we can. And if you have more questions to partners, we are always
Please.
here. We can, whatever your clients may ask, or if you need help in joint calls, Ritesh is there from Certus who is ready to help us any time of day or the month or the year, or doesn't matter. He works 24/7. Yeah, yeah. So let's best of luck to all of you. Thanks, Ashish, and see you
Thank
soon.
you. Thank you. Thank you, Manish. Thank you so much for organizing this thing. Thank you.